what I'm hoping you're going to get out of our time here is basically this. I love looking at the current market because that's really where the action's at, and that's the most applicable discussion we could have. Obviously, the most interesting as far as I'm concerned. But at the same time, I want you guys to be able to see what I'm doing and why I'm doing it and what tools I'm using to set up my trade. So as much transparency as I can give you is what I'm willing to do. If there's a tool on my chart that you're curious about, I will tell you exactly what it is, how to set it up, or how to get it, 100%. I also have a lot of video over at my YouTube channel. And I've been a little lax about my writing, about my blogging, and I'll be getting back into the full swing of things here now that it's September. One of the things that I used to love to do was take summers off. And there was a time, once upon a time, and I've been probably dating myself here as a trader, but once upon a time you could take summers off. Most people would just kind of fade away come May and come back after Labor Day. And, maybe look at the markets here or there throughout summer, but for the most part, a lot of the traders that I knew, including myself, were kind of 9 months on, say 3 months off type traders, because any of you who have done this for any length of time know that this is absolutely mentally and emotionally exhausting. To do what we do as traders, especially if you are a Forex trader, because now we're talking about a completely different level of market participation, intermarket analysis, completely different trading hours. I mean, this market just does not shut down. But we need to, right? We need to walk away. So that was what I used to do once upon a time, and I haven't done that in probably 8 years now. So for about the first 12 years, I used to do that, and the last 8 years I have not. So I've noticed a difference. I find myself taking smaller breaks throughout the year. I definitely try to take the end of August to September off, but you guys have seen the kind of price action we're having. These are historical times. I can't recall any time in my trading career, and this spans direct access for equities. This spans watching the commodity futures go from pits to electronic, and the obviously the Forex market availability here in the U.S. and so I've seen so much change. When I first used to trade, there wasn't really the internet the way we know it now. You'd call your broker up. Email was very sophisticated, and most of the time the charts that you used were either ones you drew by hand with pencil and paper, or you might have had a satellite feed, or you got them mailed to you every Monday, or they'd arrived in your mailbox every Monday. You'd update them by hand. So when I say these are historic times, I mean I'm coming from a viewpoint where I've seen a lot of changes, and the reason they're so historic is what's been happening with these currencies and with these central banks as they deal with the debt. So one of the things that, and I see here there's a question about gold, and that's a good topic to bring up here. Let's head on over there. When it comes to gold, when it comes to what's going on with the market in terms of fear, that's really the conversation we're having when it comes to gold, isn't it? Safe haven, refuge, fear. So you take a look at this contract of gold, and here's the GC contract. It's the full-size gold contract. And in terms of, it's a broad question. Obviously, anytime I'm going to enter a market, anytime I'm going to consider any kind of trade, the initial question is, what's the directional bias? And directional bias is just my fancy way of saying, is there a trend? And if there is it up or down? Simple as that. Now, the way I do that and why I do that Okay, so the way I do it's pretty simple. It's the 34 EMA wave. You know that's a staple on all my charts. So 34 EMA wave here, moving upward. You know, another thing that's blatantly obvious, and I'm obviously saying something that everybody knows because gold's sitting now at, what is it, at over $1,800 an ounce, a troy ounce. But let's say you didn't know this was gold, this chart here in front of you. Let's say you didn't know that. And you're looking at the last 6 months, 8 months of price action. One thing that I also have accompanying my 34 EMA wave are my grab candles. And if you haven't ever checked that out, I have actually, I'm putting up, I think today or tomorrow, a full tutorial as well as the downloads on grab over at my video-based site, which is, and this will be available for free, the tutorial I'm talking about, at RagheeReport.com. So I should have that up either later today or tomorrow. But I have the videos, I just have to get them online. But one of the things that you'll notice is the dominance of the green candles. Now, there's dark green and there's light green, as you can see. But there's very little red and there's very little blue. And that means that we have hardly at all shifted away from a bullish sentiment and a bullish momentum. Now, my arithmetic for a trend is essentially this: sentiment plus momentum equals trend. So if I have an organized bullish momentum, and it's organized, okay, that's a key there, and it continues, it will eventually turn into momentum. And if that momentum organizes and is able to continue, that will turn into a trend. Okay? Now we're seeing really the overall embodiment of that on gold for some time now. What's interesting to me though, and this comes as someone who has traded futures for a very long time and traded gold for on and off for almost 2 decades. What's interesting to me is everyone's got gold's attention right now, and I get that. I don't like to go back in time a lot, but you look at gold, and I don't even know that I could pull up this data here, but you look at gold, say, on a monthly or weekly basis, it wasn't that long ago. You know, you go back to 2001, so just 10 years ago. I know that sounds like a lifetime as a trader, but gold was under $300. You know, so we're talking about within 10 years, we've moved from $300, less than under $300 to now 18. Obviously, the monthly trend is up, the weekly trend is up. Trading this market, however, trading any market where there is such a strong trend really requires you to determine how it is you want to take advantage of this trend, whether your sentiment is short term or long term or just intraday, where you're not really interested in what the market's going to do tomorrow. You just want to play the momentum and the sentiment and perhaps even an intraday trend. And that's fine, absolutely fine too. But everything starts with that directional bias. So I get that with the angle of the 34 EMA wave. I get that with the dominance here of the green grab candles, indicating the bullish sentiment and momentum. And then trading this market, you know, right now, when you take a look at gold, yes, the directional bias is up. This lets me know, by the way, when I am in a counter trend trade. Very important. I'm not recommending anybody break rules. Certainly, we all sometimes bend them or massage them just a little bit. It is much easier to be bending the rules, massaging the rules a little bit in terms of your entries, in terms of your trade management, even in terms of your risk management when you are trading with the dominant trend. So if I were, for example, to get into this 15-minute short, you know, I look at the downtrend on, say, the 15-minute chart here. Okay? This is counter trend. How do I determine that? Because we just looked at the daily time frame and saw that the dominant sentiment, momentum, and trend is indeed up. So if I'm going to get into a short, that is very much counter trend. We are, however, pulling back pretty sharply from what is now a double top at 1900. If you look at the XAU, and I'm using the GC right now because that's the full-size gold contract. But obviously, since we're talking about Forex here, let me pull up. See if I can pull that up here. Just bear with me. So here's the XAU. Blow this up here, and you can see that we've definitely made that double top up there. See that? So we've peaked once at 1912. We peaked again recently at 1920. So it's an 8-point variance, which would technically be a less solid, a softer double top, but considering the price range that we're in, that's a pretty formidable show of resistance whenever the bulls are able to get their heads above the water at 1900. The bears are ready to step in. But the trend is definitely up. So now what? Well, longer term, if I want to go with the directional bias, I would wait for a correction. Now, one of my favorite things to do, and let's go ahead, I'm going to insert an indicator here. I'm going to put in a moving average. And just so you know, the indicators that I've got right now on this chart are, of course, to grab the 34 EMA wave. Here's a 200 period simple moving average down here. I'm going to put a 20 period simple moving average in. And what this does is create what I call a swing zone. Now this is obviously, since it's an uptrend, a swing buy zone. This would be an aggressive buying opportunity right now, right today, at about 1820. And one of the things I like to see in my indicators, and let's blow this up a little bit more, is when we have respect for a level that I'm expecting to act as support or resistance. Today I'm looking at this 20 period simple moving average as support, and this would be an aggressive swing buy. This whole area, by the way, between the 20 period simple on the close and the 34 EMA on the high, this green line here, 34 period EMA on the high, is my zone, which puts my area of potentially getting in here, okay? You can see there 1779.85 to 1817.22. It's a big area, but this is also a very high priced, value-wise market, and therefore sometimes the range is wider, especially when you've had a little bit more volatility like we're starting to see here. Okay? We're starting to see a little bit more volatility here. Does this often indicate a transition into distribution? I've got a double top, more volatility per candle and in my range. Okay, look at the organization before. And look at what's happening now. I usually get very cautious here. Not that I don't think there's more upside in gold. I'd be stupid to argue with the trend, but there could be more volatility, certainly, coming into this market. All right? I don't think the sun has quit shining on gold, and I do think we're probably going to test 2000. That's the next logical level. These major psychological levels often act as magnets in many ways. Okay? Let me get to another question here, and we'll keep gold here on our screen, but another question here from Philip, who asks, are the FX markets harder to trade than most currently? I'm going to take that as two questions. Are FX markets harder to trade? I think they are not. I think that the Forex market, because you have so many ways of confirming why a currency is strong or weak, in many ways the analysis is more straightforward. Okay, and again, I'm coming from a perspective where as a Forex trader talking to you now, I'm not just a Forex trader. I don't even consider myself just a Forex trader. I consider myself just a trader, period, because I've traded stocks, day trading, and end of day, and direct access, and I was in there during those day trading years, futures, options. Okay, so I'm coming to you from a pretty well-rounded background of a lot of different markets, and I would say that because when I get up in the morning, I can look at the dollar, the US dollar index. I can look at crude oil, and I can look at gold as we're doing right now. In fact, let me put these markets that I'm talking about right here in front of you. And the reason I think, again, that Forex is more straightforward is there's so many other conformational markets. The Forex Market Pulse, or what I call Forextra, gives you insight into the commodities and the markets that move economies. Okay? So the dollar, as I mentioned before, crude oil, as I mentioned before, I can look at what equities are doing, and I use the Dow Jones to get that look at the psychology of equities. This is the YM contract, which is the mini futures on the Dow, which trades on the Chicago Board of Trade. It's my preferred way of trading the Dow when I am trading it. So then I've got that. We talked about crude oil. I can look at crude. If you are trading the Canada or the Aussie, you gotta look at crude. Okay? So dollar, Dow, crude. We took a look at gold. There is such a thing as the continuous commodity index. The continuous commodity index is, if you want to have a kind of comparison, it is essentially like the S&P 500 of commodities. It's probably the best way that I know how to describe it. The S&P 500 of commodities. Okay, and you can look to see if the commodity sector in general is strong or weak. Okay, but I think one of the major ones is being able to wake up every morning and look at the dollar, look at the Dow, and get an idea of whether traders are feeling bullish or bearish on the dollar, whether they're feeling risk appetite or risk aversion when it comes to equities. Okay, so those are partly the reason I think the Forex markets are easier to trade, generally speaking, because I have so many ways of confirming why the loonie is strong, or the Canada is strong, or the euro is weak, or the Swiss is weak, or the yen is strong or weak. There's so many ways I could cross-confirm. That being said, right now it is more difficult, absolutely, because we're getting really an unprecedented degree of central bank intervention. Okay, and yes, the volatility, a lot of people love volatility, and I think there's too much made of volatility. Obviously, I can't make a living, we can't make a living from a flat market, but the kind of volatility we're seeing right now is making our risk more significant. So your risk tolerance has to be higher because of the volatility, and that's part of the way volatility works. We need it, and on some levels we loathe it. The risk tolerance has to be higher right now just because of the kind of volatility we're seeing. And again, it's just central bank involvement. Again, this unprecedented central bank involvement. They have been active in manipulating, and this is their job, by the way. I'm certainly not bashing the central banks for what they are trying to do. It's their prerogative. It's their own rationale. It has nothing to do with me as a trader. I have to accept it. But from the standpoint of getting into the media and trying to control the message, from the standpoint of obviously the physical action where they have either intervened or lowered interest rates. I mean, think about what's happening right now in the franc. We're talking about historical central bank intervention in terms of not just central bank speak, how they're controlling the media to control the message, but also we have zero overnight rate, zero central bank rate. They are doing their best to control what has been just a historical rally in the franc itself. You can see that on the dollar Swissy in front of you. They are going to, and so far they're backing it up again, because for a while you noticed they were talking a lot, not doing a lot. When I say they, I mean the S&B. And now they're acting again, and they are really, first they put out that $1.20 peg. Remember they said we want no more than that $1.20 peg in terms of euro to francs. They said it, but they really didn't do much. And if you remember, traders, the market, we hear what you're saying, we'll discount it, but if nothing happens, we're going to wind that back out. We're going to, reel that. We're going to go ahead and wind it out of the market. So we discounted $1.20. Nothing actually happened. The franc started to get strong again, and boom! Over the long holiday weekend, you saw what the S&B came out and did. Here we are, 120 and change, and this is what they wanted. This is what they said they will absolutely defend. So here we are. So to answer your question, Philip, great question. Generally speaking, Forex markets are, I think, more confirmable. Again, there's multi-levels of confirmation to be able to look at a pair and understand why it's strong or weak. I think as compared to futures or stocks. With stocks, I can look at the market in general. I can look at the Dow or the Nas or the S&P. I can look at the weighting of the stock within the average. I can look at the sector strength. I can look at the general. There's a lot of ways to confirm there too, but I think nothing has quite the confirmation that Forex has. Nobody has the hours, because remember, the kind of trading hours we have in Forex actually contributes to, I think, a much more organized chart, organized price action. We have much more consistent access, consistent market participation, which I think helps us control risk. If I'm trading futures or stocks, those markets close. News comes out during what is known as after hours or non-RTH, not real trading hours, and I'm in a heap of trouble when I want to get out or get in with everybody else. I don't have quite that in Forex, right? We have volatility, but I've got access Sunday afternoon to Friday evening consistently with liquidity. You can't say that in any other market. So yes and no, Philip. I hope that answered your question. Was there divergence yesterday in the 1 hour chart? I don't use divergences, so I could certainly discuss it, but since I don't use it, I would rather not. I hope you can respect that. I don't use divergences at all. I'm not looking for, if I'm looking for, but let me back that up. If I am looking for overbought, oversold, or when the market might be on its tippy toes, if I'm looking for those turning points, those inflection points, I'm only going to do so in a market that's range bound. I'm only going to do so in a market where I can confirm a 2 to 4 o'clock angle. And I'm going to use, typically, my preferred indicator is the Stochastic Oscillator. And what I like to do is set it on a pretty slow setting. Okay, let me show you here. There it is. And that's what it looks like. And I'm much, you notice how I made, and let me show you again what I did. You notice how my signal line is bold. And that's the smoother of the two lines, by the way. I'm much more interested in the over 80 and under 20 reading. And, feel free to get into the MT4, whatever version you have, and change the colors around so there's more pop in the readings. I think it makes life a whole lot easier. Okay? So if I'm looking for that type of viewpoint, I'm definitely not a divergence person, and certainly I'm not saying it doesn't work. It's just not my preferred way of analyzing the market. So let me, suffice to say, probably the wrong person to ask. I simply just don't use it. I just have not found it to be something that works for me. Everything starts with the market trend. So if I was looking for some sort of range-bound opportunity on, for example, I believe this question was on the XAU. Is that correct? What I'll look to do is I'll go to a time frame that perhaps is in the type of market phase, market trend that would be applicable to this. And actually, I don't believe that we do. In fact, mostly we're dealing with downtrends and intraday. The 15, the 30, the 60 are all in what I call 4 to 6 o'clock downtrends, where I'll be looking to swing short these markets on rallies. But overall, and I mentioned this already, we're sinking into a swing buy, very wide area. One word of caution here, and this is how you want to perhaps time any entry that you might want to have in the daily XAU, is don't get long the XAU daily until you see the 15, 30, 60 minute, these building block shorter term time frames, even the 5 minute. Wait till these time frames, look at even the 5 minutes still pushing lower. Wait till these start to level out. Wait till the 34 EMA wave starts to flatten out before you even consider hopping into one of these, into any market. XAU, the buying opportunity. Yes, we're in the aggressive area of it, but wait till that 5 minute or the 15 or the 30 start to show you that there is some buying support stepping in, which I suspect we may see near term at the major cycle level around 1805. The major psychological level support will kick in at about 1805 and extend down lower to 1795. Okay? So wait till those short-term time frames lose that bearish momentum. All right, so thank you as always for joining me. I'm Raghee Horner, and I will see you next week. Thanks so much for your questions, too. I really appreciate it.